Most people come into XRP asking the same question over and over again: why hasn't the price moved yet? And on the surface, that sounds like a fair question. Price is visible. Price is emotional. Price is what everyone has been trained to watch. But that question already reveals the real problem, because it assumes price is the primary signal. And with XRP, price has never been the primary signal. Let me start somewhere most people never do. When engineers design a bridge, they don't ask how much the bridge costs on day one. They don't ask whether people are excited about it. They don't ask if traffic is heavy yet. They ask a very different set of questions. How much weight can it carry? How does it behave under stress? Does it still function when the rest of the system is under pressure? Infrastructure is built for failure scenarios first, not for applause. And XRP was designed the exact same way. So if you're watching XRP and feeling frustrated because price hasn't validated your patience yet, you're still asking the wrong question. The real question isn't why hasn't it moved? The real question is, what was this system built to handle when pressure shows up? Because that's when infrastructure reveals its value, not during calm markets, during stress. Before we go any further, let me be very clear. This is not financial advice. This is educational content meant to help you understand how systems are designed so you're not reacting emotionally to price. And if these kinds of breakdowns help you think more clearly instead of more anxiously, hit the like button, subscribe if you haven't already, and drop a comment below. I'm genuinely curious. Are you looking at XRP like a trader, or are you looking at it like infrastructure? Now here's where the disconnect really begins. Most retail investors look at assets from the outside in. They start with charts, candles, support, resistance, short-term movement. That's not wrong. It's just incomplete. Institutions do the opposite. They look from the inside out. They ask, what problem does this solve? What happens under stress? Can it move value at scale? And can it still function when markets are unstable? That difference in perspective explains almost all of the confusion around XRP. XRP was never designed to behave like a speculative asset first. It was designed to behave like financial plumbing, the part of the system you don't think about until it fails. And once you understand that, price stops being the main signal. Function becomes the signal. Here's how institutions actually define value, because this is critical. Large financial systems don't break because prices fall. They break because money can't move, settlement takes too long, liquidity fragments, slippage explodes, counterparty risk spikes. At institutional scale, those aren't inconveniences, they're catastrophic. That's why institutions don't ask, what can I sell this for later? They ask, can this asset carry massive flows without breaking the system? XRP was engineered to answer that question. It's not a company, it's not equity, it doesn't represent ownership in Ripple, it's a liquidity instrument. And liquidity instruments have a design constraint most people completely miss. They must scale in value as volume increases. Because XRP has a fixed supply, it cannot support larger flows by creating more units. The only way it supports scale is by each unit representing more value. That isn't hype. That isn't a price prediction. That's basic system design. So when someone asks, why is XRP still around this level instead of skyrocketing? They're still thinking like a consumer watching a price tag. The system is asking something very different. Can this asset support global liquidity when stress hits? And that's why the build happens first, long before price reflects it. I'm going to keep repeating this because it's the recalibration most people need. When it comes to infrastructure, certainty matters more than perfection. In moments of financial stress, currency instability, liquidity crunches, geopolitical shocks, decision makers don't look for perfect solutions. They look for certain ones. Speed and certainty matter more than theory. That's where regulatory clarity comes in, and most people misunderstand it. Institutions are not waiting for a perfect global rule book. They're asking, can we legally use this asset right now? Will it settle without friction? And does it reduce risk or introduce it? XRP answered one of the most important questions already. A court ruled it is not a security. That doesn't mean every regulation is finalized. It means uncertainty was removed where it mattered most. And in a crisis, certainty beats perfection every single time. This is why infrastructure assets don't explode overnight. They get positioned quietly, legally, and structurally before anyone needs them. And once they're embedded, behavior changes first. Price adjusts last. Now let's talk about something that confuses almost everyone watching from the outside: silence. Because when price isn't moving, when headlines are quiet, when nothing looks exciting, retail assumes nothing is happening. Institutions assume the exact opposite. Silence in their world often means positioning. Here's the uncomfortable truth. Large financial players do not build exposure the way retail does. They don't buy on public exchanges with market orders. They don't want volatility. They don't want attention. And they absolutely don't want price spikes while they're still setting up. Their goal is controlled entry, minimal slippage, predictable settlement, and legal certainty. That kind of activity does not show up as fireworks on a chart. Most institutional positioning happens off exchange. It happens through custodians, OTC desks, structured products, and private agreements. It happens quietly, gradually, and deliberately. If you were seeing aggressive upside while that positioning was taking place, that would actually be a red flag, not a success. It would mean instability, thin liquidity, and unpredictable execution. Institutions hate that. This is why infrastructure assets often look boring at the exact moment they are being prepared for scale. Stability is not accidental. It's a requirement. When an asset is intended to move large amounts of value, price behavior during the positioning phase needs to be calm. Think about it logically. If you're trying to route billions through a system, the last thing you want is wild price swings while you're still integrating it. Retail misreads this completely. Retail sees low volatility and assumes disinterest. Institutions see low volatility and see reliability, two completely different interpretations of the same signal. And this is where XRP gets misunderstood again. XRP is not being positioned as a speculative trade. It's being positioned as a tool. Tools are evaluated on whether they work consistently, not on whether they generate excitement. No one cares if a settlement layer is thrilling. They care if it clears fast, clears legally, and clears without blowing up balance sheets. Another critical piece here is time. Institutions move on timelines that don't match social media cycles. They plan in quarters and years, not in days and weeks. That's why expecting immediate validation from price is a mistake. Price is a lagging indicator in systems like this. Structure comes first. Access comes second, behavior changes third, price responds last. This also explains why XRP's activity often doesn't look like traditional accumulation on a chart. A lot of the positioning doesn't happen where you can easily see it. And even when it does touch open markets, it's absorbed slowly, intentionally, without creating obvious signals. Quiet absorption is the goal. Noise is the enemy. Here's the part that's hardest for most people to accept. If you're waiting for excitement to confirm value, you are waiting for the final stage of the process. By the time excitement shows up, positioning is already done, the system is already in place, the participants are already committed, and the risk reward has already changed. Infrastructure does not announce itself. It prepares. That's why nothing happening is often the wrong conclusion. What's actually happening is preparation without spectacle. And if you understand that, patience stops feeling like weakness and starts feeling like alignment with how real capital operates. Now let's talk about stress, because this is where the real difference between speculative assets and infrastructure assets finally shows up. Systems don't reveal their value when everything is calm. They reveal it when something breaks. And financial systems don't break in obvious ways at first. They break quietly through friction, delay, and loss of trust. When stress hits global markets, the first thing that suffers is not price. It's liquidity. Money stops moving smoothly, settlement slows down, spreads widen, counterparty risk increases. Institutions don't panic because prices are down. They panic because transfers fail, capital gets trapped, and obligations can't be met on time. That's where losses compound very quickly. This is why liquidity instruments exist in the first place. Their job is not to perform during ideal conditions. Their job is to function when conditions are bad. XRP was designed specifically for that role. It wasn't built to look good on a chart during a bull run. It was built to move value when currencies are unstable, when markets are fragmented, and when speed and certainty suddenly matter more than cost. Here's something most people miss. During periods of stress, institutions do not want optionality. They want certainty. They want to know that when they send value, it will arrive quickly, legally, and predictably. Every extra second, every intermediary, every unresolved legal question adds risk. That's why systems that look over-engineered during calm markets suddenly become essential during disruption. XRP's design makes sense only when you think in these terms. It settles quickly. It doesn't rely on multiple layers of intermediaries. It reduces counterparty exposure, and it operates as a neutral bridge between systems that otherwise don't trust each other. Those features don't matter much when markets are stable. They matter enormously when they're not. This is also where the fixed supply argument becomes relevant in a way that has nothing to do with hype. When stress increases, volume increases, capital moves faster and in larger size. A liquidity instrument cannot handle that by printing more units. That would introduce instability. Instead, each unit has to represent more value so the system can move large amounts efficiently without overwhelming itself. That's not a prediction, it's a requirement. Large systems do not want to move millions of units if they can move thousands. Efficiency at scale demands higher notional value per unit. This is how real financial infrastructure behaves, whether people like it or not. And this is why price often feels disconnected from fundamentals during calm periods. The system is not being tested yet. Adoption doesn't show up as excitement, it shows up as readiness. Readiness to handle volume, readiness to handle stress, readiness to function when something goes wrong elsewhere. Retail traders often ask, why would institutions wait until a crisis to care? They don't. They prepare before the crisis so they're not scrambling during it. By the time stress is visible to the public, the tools institutions rely on are already chosen, already integrated, already trusted. That's the part most people never see. They only see the moment when usage spikes and price reacts. They don't see the years of quiet preparation that made that reaction possible. So if you're judging XRP only by how it behaves during calm markets, you're judging it in the wrong environment. It's like judging a fire escape based on how often it's used when there's no fire. Its value isn't in everyday convenience. Its value is in reliability when it's needed most. Now let's connect all of this back to the part everyone obsesses over, price, and explain why price is almost always late to the story when you're dealing with infrastructure. This is where most people completely misread what's happening and end up positioning themselves at the worst possible time. Price is not a leading indicator in systems like this, it's a lagging one. By the time price starts moving in a way that feels obvious, the hard work has already been done, the structure is already in place, the access is already granted, the legal questions are already answered, the participants are already positioned. Price doesn't lead adoption, it reflects it after the fact. Retail tends to assume the opposite. Retail believes price movement creates value. Institutions know price movement usually follows value that's already been established elsewhere. That difference in belief is why retail often arrives late, confused, and emotional, while institutions arrive early, quietly, and prepared. Think about the sequence logically. First, a system has to exist, then it has to be legally usable, then it has to be integrated into workflows, then it has to be trusted under stress. Only after all of that does behavior change at scale, and only after behavior changes does price have a reason to adjust meaningfully. Skipping steps doesn't work, no matter how badly people want it to. This is why XRP can feel frustrating to watch. You see development, partnerships, legal clarity, and infrastructure expansion, but price doesn't immediately reward that patience. That's not because the market is broken, it's because the market is following the correct order. XRP is not being adopted as a trade, it's being positioned as a function. And functions don't get repriced until they're indispensable. Another mistake retail makes is assuming adoption happens in open markets. It doesn't. Most adoption happens behind closed doors, through pilot programs, private rails, custodial integrations, and enterprise agreements. None of that requires public price discovery. In fact, public price volatility during those phases is undesirable. Stability is a feature, not a bug. This is also why price can stay flat for long periods and then move very quickly once conditions change. When positioning is already complete and usage increases suddenly, often triggered by stress or disruption elsewhere, price has to catch up all at once. That's when people say things like, it came out of nowhere. It didn't. They just weren't watching the right signals. Understanding the sequence changes how you behave. You stop waiting for excitement to tell you something matters. You start watching for structure, access, and certainty instead. You stop asking why price hasn't validated your patience yet. You start asking whether the system is closer to being unavoidable than it was before. And this is where discipline comes in. It's much easier to be patient when price is moving up. It's much harder to be patient when price is quiet. and nothing feels rewarding. But infrastructure doesn't reward impatience. It rewards alignment with the process. If you misread silence as stagnation, you'll exit right before the conditions change. If you understand silence as preparation, you'll stop fighting the process and start positioning with it. That doesn't guarantee outcomes, nothing does, but it does put you on the right side of how real systems evolve. So let's bring this all together, because once you see the full picture, the way you look at XRP and markets in general should fundamentally change. What you've been watching unfold isn't a story about excitement, hype, or short-term validation. It's a story about design, preparation, and how real systems are positioned long before they are needed. Most people spend their time reacting to markets. They wait for price to move, for headlines to confirm what they already hope is true, for excitement to justify their patience. But that mindset is backwards when you're dealing with infrastructure. Infrastructure is built quietly, it's tested in advance, it's integrated before anyone is watching, and by the time it becomes obvious, the opportunity has already shifted. XRP was not designed to entertain traders. It was designed to solve a specific problem at scale, moving value quickly, reliably, and legally between systems that don't naturally trust each other. That design only becomes truly valuable under pressure, when liquidity is strained, when settlement speed matters, when certainty matters more than theory. Judging XRP by how it behaves during calm markets is like judging a backup generator by how often it runs when the power is on. This is why silence doesn't mean failure. Flat price doesn't mean stagnation. And lack of excitement doesn't mean lack of progress. What it usually means is that positioning is happening in the background, through channels that aren't visible on a chart. Institutions aren't waiting for hype. They're waiting for certainty. And once certainty exists, they prepare. They don't announce. If you can shift your mindset from watching candles to understanding systems, everything changes. You stop chasing validation. You stop reacting emotionally. You stop confusing boredom with danger. Instead, you start asking better questions. Is this asset more legally usable than it was before? Is it more integrated than it was before? Is it closer to being relied on under stress than it was before? Those are the questions that actually matter. That doesn't mean outcomes are guaranteed. Nothing in markets is. XRP still carries risk. Adoption can take longer than expected. Competition exists. Timelines can stretch. Anyone promising certainty or fixed outcomes is lying to you. But there is a massive difference between blind hope and informed patience. One is emotional, the other is strategic. Understanding systems, instead of obsessing over price, puts you in a completely different category of market participant. You're no longer waiting to be told what matters. You understand the process well enough to see it unfolding before the crowd does. And that doesn't make you smarter, it makes you calmer. And calm decision-making is one of the most undervalued edges in any market. Before we end, it's important to be absolutely clear. This content is for educational and informational purposes only. It is not financial advice. I am not telling you to buy, sell, or hold XRP or any other asset. You are responsible for your own research, your own risk management, and your own financial decisions. Markets involve risk, and nothing discussed here should be taken as a guarantee of performance or outcome. Always do your own research and only invest what you can afford to lose. If you can take anything away from this, let it be this. Stop asking markets to entertain you and start asking whether you understand the system you're observing. When you do that, patience stops feeling passive and starts feeling intentional.